Okay, let's get started with Chapter 3, Governmental Operating Statement Accounts and Budgetary Accounting. Okay, the first thing we're going to cover is governmental fund balance sheet accounts and governmental fund operating statement accounts. We're going to go over budgetary accounting, which is going to be new to you in terms of it not being like for-profit businesses. Going to go over budgetary accounts, and then we're going to cover some examples of budgetary accounting. Governmental fund balance sheet and operating statement accounts is what we'll cover first. Governmental fund balance sheet accounts are comprised of assets, liabilities, and these are current assets and current liabilities. And that's an important distinction because remember, governmental funds have a current resources measurement focus versus the economic resources measurement focus that other funds have or that for-profit business has, and therefore the governmental funds are the ones that use the modified accrual basis of accounting. Fund balances are equal to assets minus liabilities, and what differentiates fund balances from retained earnings on the for-profit side is that citizens of a government don't have a claim on the resources of the government, whereas the owners of a business do, and therefore that's what differentiates retained earnings from fund balances for governmental funds. Governmental fund operating statement accounts, there's four types. There's revenues, expenditures, other financing sources, and other financing uses. Revenues are any receipt by a government that is not classified as other financing sources, like an intra-fund transfer or otherwise a transfer from another fund, or issuance from debt, proceeds from the issuance of debt. Expenditures are defined as a cost to purchase a good or service. And you remember that on Chapter 2 we defined expenditures and expenses. And remember that expenses are the cost of a good or service consumed. And as an example, if a government were to buy a truck for $30,000, that would be the entire $30,000 would be recorded as an expenditure. Whereas on the government-wide financial statements, they use an economic resource. Budgeting may be the most important responsibility of a government legislator. The citizens of a government expect the leaders to prioritize community programs, to authorize the expenditure of resources that are going to meet the goals of the government, to comply with laws over spending appropriations, and finally to demonstrate stewardship over public funds in the long run. Budgets are legally approved plans of financial operations, and they embody the authorization of expenditures for specified purposes that are to be made during the budget period and the proposed methods of financing them. Therefore, expenditures are planned first, then plans are made to finance the expenditures. Budgeting is also an important tool for achieving efficient and effective management of resources. GASB requires governments present the budgetary comparison schedule after the notes of the financial statements, or the government can present a more traditional statement that compares budget to actual operating performance, and they can present that within the basic financial statements. We're going to cover 6 types of budgetary accounts: estimated revenues, appropriations, estimated other financing sources, estimated other financing uses, budgetary fund balance, and encumbrances. Estimated revenues, you'll notice even though it has the word revenue in the title, and you're going to notice this about all these budgetary accounts, they're in reverse of what you would normally book for a revenue. So estimated revenues, even though it has revenue in the account title, they have a debit balance. And these are expected assets. These are the amounts that are expected to be collected from a governmental body's main sources of revenue, such as taxes, fees, or fines. Appropriations, these are expected liabilities. They represent the total amount authorized to be expended by the government for the fiscal period. When the liabilities are incurred, the appropriation is said to be expended. In other words, when the liability is incurred means when the service has been rendered but payment hasn't been made. That's when the appropriation is said to be expended. Thus, expenditures are expended appropriations. So if appropriations have a credit balance in them, then when the expenditure actually takes place, you're going to reduce that credit balance with a debit entry. We'll cover some examples later. In other words, and another word for appropriations is estimated expenditures. Estimated other financing sources, like estimated revenues, also have a debit balance. These are expected assets, but these are sources of government financing other than its main revenue sources like taxes, fees, etc. Examples of these are the face amount of long-term debt, the issuance premium on long-term debt, and any intra-fund transfers. And again, these expected financial resources or financial inflows are recorded as other financing sources instead of estimated revenues because of the governmental funds having a current financial resources measurement focus. Estimated other financing uses, they have a credit balance, as do the appropriations. These are expected liabilities, and they are generally an expected outflow of resources to another fund. Examples of these include an issuance discount on long-term debt, as opposed to the premium that's other financing source, or inter-fund transfers for debt service. The fifth type of budgetary account is pretty easy. It's budgetary fund balance, and basically it's just the difference between your debits and your credits for your other budgetary accounts. And more formally, it's the difference between appropriations plus estimated other financing uses and the sum of estimated revenues and estimated other financing sources. And it can have a debit or a credit balance. The sixth type are encumbrances, and these are used to record an expected liability when a purchase order or a contract has been issued. And these are used only for governmental funds. The word encumber is used in place of the word expended because an encumbrance is only an estimate of the liability that's incurred instead of when the purchase order is actually filled or the contract is completed. Those entail the recording of a expenditure. This concept may be new to you because, in the for-profit world, expenses are only recorded when goods are delivered or services are received. But in this case, the difference between between encumbrance and an expense or expenditure is an encumbrance is a estimated liability that is recorded when the product or service is ordered, as opposed to an expenditure and expense that are recorded when the service is actually provided or the good is delivered. So now we'll move on and do some examples. This is a simple example of recording the budget. Okay, so let's assume that the budget provides for estimated revenues, or in a lot of cases, like in your Smithville application, it might say that the budget that they expect to receive $1.2 million in tax revenue. That's going to be your expected revenue entry. Also, the budget approved appropriation of $850,000 and estimated other financing sources of $250,000. Remember from a couple slides ago that estimated revenues, when you're recording it, are going to have a debit balance. The approved appropriations of $850,000 and the estimated other financing uses are both going to have a credit balance. And that's seen right here in this simple budget entry. Now, the entry doesn't balance. The balance, or the plug entry, is going to go to budgetary fund balance for $100,000. And you'll see that's a credit to make debits equal credits in this example. Now we're going to cover an example of how to record encumbrances. The state has contracted to purchase road maintenance equipment for $750,000. Remember, we're recording an estimate here. The purpose of an encumbrance is to earmark a portion of the fund balance for the estimated cost of goods or services ordered. And again, this is not an appropriation because we don't, or a expenditure because we don't know the exact amount. And lots of times, the amount on a purchase order is going to differ from the amount that ultimately ends up on the invoice. So in this case, you would record a debit to encumbrances for $750,000, and you record a credit to an account called Reserve for Encumbrances for $750,000. The second part of this encumbrance example is when their actual cost is known. When the contract is complete or the goods are officially delivered. So in this case, the actual cost was $745,000, and the state issued a vouchers payable. The encumbrance issue, the first part of this is that original encumbrance issue entry is reversed to the extent that the purchase orders are filled. So in this case, the entire purchase order was filled. It just happened to be $5,000 less. But we're going to reverse the original entry completely. So you'll notice there's a debit to Reserve for Encumbrances and a credit to encumbrances for the full $750,000 that was originally recorded. The second part of the entry is to record the actual legal obligation to pay the actual amount of the purchase. And in this case, it was $745,000. So you're actually going to debit an expenditure to record it, and record the liability. In this case, and in a lot of cases in your Smithville application, it's going to be a credit to vouchers payable for $745,000. I hope this information has been useful to you, and there's also a practice problem included in this learning module that will be helpful to you.